Hello and welcome to our discussion on the accounting equation. In this session, we will try to understand the process of converting certain transactions into the accounting equation. And we know that accounting equation at any point of time shows that the assets of a company will have corresponding sources. So S will be equal to A at any point of time. You cannot have assets without the corresponding sources. So we'll pick up one by one of these transactions, understand the principle behind the process of converting a business transaction into the accounting equation, and in the later part we will see how the same transaction will appear or can be converted into the financial statements. So started business with a capital of 50,000 is the first transaction. So the accounting equation will be the sources is capital and the corresponding cash is the asset. So after this transaction, the company has a cash of 500,000 and capital of 500,000. So asset is equal to corresponding source, and the source here is capital. So the company raised money by issuing 9% bonds. Okay, so 9% bonds. So 9% bonds is another source. So the cash to that extent increases 700,000 and no change in the capital, and there's a new source of bonds comes into picture. Now if you see the company is having cash of 700,000. Now with this 700,000 the company purchases goods worth of 80,000 for cash. So if company purchases goods worth of 80,000 for cash, so the stock will reduce to the extent of 80,000, and a new asset gets into the accounting equation, that is stock of goods. No change in the capital and no change in the stock. Purchase furniture on credit from M Limited. So the company acquires furniture, another asset, but unlike the previous transaction, in this case the company purchases the asset on credit from M Limited. So a creation or acquisition of an asset resulted in creation of a liability called M Limited. In the previous case, acquisition of asset like stock resulted in decrease or fall in the cash. Now they acquired a technical know-how from Mr. X for cash 25,000. So another asset gets into the accounting equation. So acquisition of asset in this case 25,000 results in the reduction of cash 25,000. No change in the stock, no change in the furniture, and no change in the capital, bonds, and M Limited. So we are able to see that every transaction affects the accounting equation in such a way that after the transaction recording, S will be equal to A. So 40% of the stock, so 80,000 stock is there, 40% of the stock is sold for 200,000 and it is a cash transaction. So therefore the stock will reduce to the extent of 40%. So stock will become 80,000 minus 32,000, which is 40% of 80,000, and cash will increase by 200,000. No change in furniture, no change in know-how, no change in the capital, no change in bonds, no change in M Limited, but since the stock has been sold at a at a price higher than the cost, there will be profit. So profit is equal to 200,000, which is the sales, minus the cost of goods sold, which is 32,000. So profit at this juncture before any other expenses, 168,000. Then now company purchases shares for cash. So acquisition of share is another asset. It is an asset because it has the ability to generate future cash flow, and this acquisition has resulted in reduction of cash to the extent of 100,000. Okay, cash reduces and another asset appears on the equation. So therefore, acquisition of asset may result in reduction of cash or creation of liability here, which we have seen for M Limited. Salary paid for the period. We are assuming the period is 1 year. So salary for the period is 30,000. So this is an expense. Expense is anything the benefit of which has expired. So therefore, if expense is there, profit will reduce to that extent. And since it has been paid, cash will reduce to the extent of the money paid. So cash reduces to the extent of 30,000. And profit also reduces to the extent of 30,000. Profit also reduces to the extent of 30,000. So an expense reduces cash if paid in cash, and expense will reduce that profit to that for that period. Similarly, the rent, which is same as the salary treatment. So therefore, cash reduces to the extent of 50,000 and profit reduces to the extent of 50,000. So therefore, we are able to see that at any point of time, the accounting equation shows that if there will be an asset, there has to be the corresponding sources. And at this juncture, in this case, in this example, the sources are capital, 9% bonds, N Limited, supplier of furniture, and the profit, which is a part of the shareholders' money. And they paid interest. So they paid interest on this loan, 8%, 9% interest. So if the interest is paid, okay, if interest is paid, so to that extent, the cash will come down, cash will reduce to the extent of 18,000, and profit will reduce to the extent of 18,000. No change in M Limited, no change in bonds, no change in capital, no change in stock, furniture, know-how or shares. And equation tallies once again. But observe here, now we are taking another expense which is required to be paid, but we did not pay. The company did not pay. So the first question that should come to your mind is, if we have not paid, should we record it? The answer to that question depends on the accrual concept. The accrual concept says the transaction should be recorded at the time of happening of the event. Actual receipt or payment of the cash is not going to affect the recording of the transaction. So therefore, the expenses, commission is an expense. Since it's an expense, profit will come down to the extent of 10,000. However, there will be no reduction in a cash because we have not paid any cash. But it will be payable in the future. So commission payable is a liability. An expense paid is a reduction of cash. Expense not paid is a creation of liability. But in both the cases, whether paid or not paid, profit will reduce to the extent of the expense. So profit is equal to sales minus the cost of goods sold minus salary minus rent and minus interest minus commission, even if the commission has not been paid. So the profit of the company is now 60,000. Let us assume that the company has to decide about the profit. At this juncture, let us assume there is no tax. Okay, so the entire profit is distributed as a dividend. If that happens, if the entire profit is distributed as dividend, it's called distribution of profit. And to that extent, the cash will reduce and retained profit will reduce. Okay, so retained profit will become zero. If profit is not distributed, then it remains as a retained profit. If profit is distributed, then it becomes zero. And now how much stock is left? We have 48,000 stock is left. So what the company can do? The company can sell the stock or keep it with the company, sell it later, and the stock will appear as an asset in the balance sheet because it will generate future cash flows. But in this case, suppose the entire stock is sold on credit, okay, on credit for 250,000. If it is sold for credit on 250,000, stock will become zero. Debtors will be 250,000. It's an asset. You may ask a question, why are you recording the debtor? We are recording the debtors because of the accrual principle. The accrual principle says both cash and credit transactions should be recorded at the time of happening of the event. But since the stock has been sold at a higher price, there will be profit. So therefore, profit at this juncture is equal to sales minus the cost of goods sold because you have not made any expenses at this juncture. Okay. Now, this is an asset. Debtor is an asset because we are going to collect money. What will happen if when you collect this money on the and its effect on the equation? If you collect money from the debtors, cash will increase, debtors will decrease. Okay. So suppose we collected 50% of the money due from the debtors. Okay. So in that case, the debtors will reduce to 125,000 and cash will increase by 150,000. So we can observe that every transaction, because they have a financial items in that, affects the equation in such a way that at any point of time the company's assets will be equal to the sources. Okay, so for the time being we'll ignore the tax. Okay, so I'm not picking up the tax now, so tax I'm not. Okay, so I ignored the tax now. So therefore, if you see, if you want to summarize this equation, the summary of the equation is asset is equal to equity plus liability. So this shows the total, the details of assets, details of equity, details of liability. So let us see what is this equity means. Equity is capital plus profit. This is the shareholders' money. Liability is outsiders' money, bonds, the commission payable, M Limited, these are liabilities. So as we mentioned earlier, that equation will always show the composition of the source and assets. So the source here is E and L, and the details will show the composition of E and composition of L and composition of assets. So we can observe, we can see that at any point of time, the asset is equal to, okay, so we can see that once again. Okay, so right, 877, let me copy that here. Okay, so asset is debtor. I'm removing so that we can observe right from the beginning. So assets, I'm taking the last one first. So therefore asset is equal to cash plus stock plus furniture plus know-how plus shares plus debtors is an asset. And equity is equal to capital plus retained profit, ignoring the tax, and the liabilities are 9% bonds plus M Limited plus the commission payable is a liability. We can see that the summation of E and L is equal to 1.02 million. And we can copy this to rest of the, so that we can see, okay, so we can see that at every point A is equal to, after every transaction, A is equal to E plus L. But it is necessary to understand that every transaction that we come across can be explained, can be examined, can be analyzed by first observing its effect on the accounting equation. In the later part, we'll see that this accounting equation is actually the backdrop for the financial statement, because normally you don't see this accounting equation of any company on the annual report. What you see is the financial statement. So what is important is how are these financial statements prepared. But for the time being, in this exercise, we saw how the transactions are converted into a detailed equation and a summary equation. Thank you very much.